Dimitri, welcome to Beyond MD. I know we've been kind of talking about connecting for an episode for some time, and I'm super excited to connect with you today. I always enjoy talking to you, and I think people are going to really enjoy hearing what you have to say today. So, welcome. And I think a lot of people may already know you through physician empowerment, but for those who don't, why don't you just take a minute to just tell us a little bit about yourself?
Sure, and then thank you again for the invitation. I'm really excited. It's going to be a good talk for sure.
Yeah, absolutely.
You're a very smart guy and a good investor as well. But I'm a general practitioner, and I'm based out of Ottawa, Ontario, and Gatineau, Quebec. And I specialize both mostly in sexual health and trans health. But in terms of the financial part of my resume here, I have been involved in financial education for healthcare professionals since about 2016. And I'm currently a conference speaker and I guess podcast host actually for Physician Empowerment, which
That's
is
right.
where we've met.
Yeah.
And I've been a retail investor for 15 years. I've survived 15 years of in the market.
Years, eh?
Yeah,
Oh, you have a lot more. You have a lot more experience than I do. This is exactly why I wanted to have you on. So
great.
Yeah. So Dimitri, you've always struck me as the type of person who was really, really interested in finance, and even the conversations that I've had with people we both know. Like I've talked to Kevin Milo multiple times about you, and he has told me, like, Dimitri, when it comes to the markets, like, he's just a total wizard. And so this is kind of why I wanted to have you on. And this is, I don't want to send the message to people that investing in the markets is everything, but the reality is that for a lot of us, it's a major source of building wealth. So just tell me, how did you get to this point of being so interested? Was this like dinner time conversation for you growing up, or like what sparked what lit the spark inside you?
It wasn't dinner time conversation. My parents are Eastern European, coming from a communist country, so money was not something you talked about at all, right? In fact, my idea of investing before 2008, which is what actually caused me to become more interested, was you put money in the bank and you live off the interest, right? Very unsophisticated. But I was a second-year medical student in 2008 in Toronto, so I heard all the stories of all these doctors. It was very traumatic. All these doctors having lost like 60 to 70% of their savings in a couple of months, right? And having to come out of retirement and having to work. You're talking about 70, 80-year-old people having to work. And it scared me because I was like, I don't understand this. I don't understand what's happening, and obviously I'm going to be in that situation at some point in the future, so I should sit down and educate myself. And I started reading about capitalism, the financial markets, listening to podcasts. And what was interesting is I really loved it because it combined two of my favorite subjects. One is math, so numbers go up and down, right? And the other one is psychology, behavior, because that's the stock market, numbers and behavior. I remember my first exposure to dividend investing was I don't know how I read this book, but it was a guy, Canadian guy. Maybe you know him. It's Derek Foster. He wrote the book called
I know
The Lazy.
the name. Okay.
Yeah, yes.
Yeah.
I met him. He's a hustler for sure. But he wrote a book called The Lazy Investor.
Yeah.
And I read it, and his shtick was that he was able to retire early by investing in dividend stocks that do drips being dividend investment plans, right? So that's how I was first involved with stock picking and dividend investing. But to be frank with you, you know what happened? The real reason I'm here today and I became much better at this is because of Kevin Milo, of all people.
Yeah.
So I know Kevin for a while. He's one of my best friends. And we went to Mac together. And we just happened to be teaching together. We taught this course for medical students. We had such good chemistry. He's an amazing teacher. He's much better than I am. But we had such good chemistry. And when emergency was done, we said to ourselves, we should do this again. We're good at this. So he called me up and said, listen, I really want to build a course for medical professionals about investing and about financial planning and about personal finance. And he said, I'm going to be the guy who does the real estate and you stick to stocks and bonds because I had some knowledge. And I said, yes, let's do it. But of course, as a teacher, you need to actually, if you teach somebody something, you need to have done it. Because I had a lot of theory, but, I did some fundamental analysis, but I had mutual funds and a financial advisor. So I told myself, you know what, let's actually put all this theory into practice. I left my financial advisor, I switched to another online brokerage, I sold my mutual funds, which is a good decision back then for sure. And I went into it. I went to fundamental analysis. I started building my own portfolio. I even studied technical analysis. And it's really that. It's really because I wanted to teach it. And because Kevin asked me to do it, that I became much smarter and much more learned.
That's wonderful. I mean, I know Kevin Milo really well too, and he's a wonderful guy. So much energy, so much positive energy, and you can see just a real desire for teaching, and he's good at it. So it's great to hear you talk about all this as well. So, Dimitre, let's get into it then. So, in terms of how you go about investing, like, public instruments, private instruments, ETFs versus individual stocks, and the accounts you use. Can you give us just like a broad overview first of how you go about this, and then I can kind of pick away at the details a bit?
Sure. Maybe I'll talk about my portfolio. Maybe that can give us an idea on the jumping off point. And again, I know people will criticize this, but it's what worked for me. And I'll start off with probably the biggest contention point is I have about 20% of my portfolio in cash and cash equivalents. Cash is trash, but it's what I'm comfortable with. It gives me an emergency fund. And also if I need to invest in something, because some opportunities come up and they go away, I have the cash to do it. And it's generating a bit more income nowadays because interest rates went up, right? So before it was pretty bad. But it's about 20% of my portfolio. Again, I realize that's a bit too much if you look at what people say, but that's what I'm comfortable with all these years. And certainly with what's happening now in the market, it's what I'm comfortable with as well. About another 20% actually is in a holding corporation where I've invested in real estate through limited partnerships. Then you have the bulk of my portfolio, which was my RSP. It's about 40%. Now I've switched to a pension plan, so that's changed. But before I did switch to the pension plan, my RSP was about 60% stocks. So it's a mix of ETFs, broad market, US and world ETFs, and single individual stocks. About 30% of it to 35% was bonds. And I had a small percentage in oil and precious metals. My TFSA currently is mostly individual stocks and a bit of cash equivalents. And because I'm a millennial, when I bought the hype, 5% of it is in a non-registered account, invested in crypto. Yeah.
Okay.
Good old Ethereum, Bitcoin. Yeah. That's what I'm dealing with right now.
Okay. Let me ask you about the 20% cash. I personally like that because that's how I have proceeded most of the time as well. I would say, as we have dips in the market, I'll deploy more, and I'm probably a little bit less than 20% cash now. But here's the thing: if I go back, Dimitre, like if I just had put it all in when I started, or like let's say back in 2020, I feel like I would have been much better off now. So I guess if I am playing devil's advocate and saying, okay, instead of holding on to cash, why not just have more time in the market? Can you just address that a little bit? Because to me, sure. I still don't know if the way I'm proceeding is the right way. And I hold cash, maybe not as much, but similar to you.
It's a really good question. And there's no right answer. The reason why I do this is because, first of all, I need an emergency fund, right? Yep. You don't know what's going to happen. I'm changing careers currently. Yep. So you need to have some money to live. But I would push back a bit and say that, for example, when there's a big crash during COVID times, right? It's because I had cash, I was able to put some in the market, and I did very well. Now, I'm not saying I timed it correctly, but certainly I had extra cash to buy some individual stocks, which did really well. Now, if you don't have that, it's fine. It's fine. I think it is, but I did, and I was able to deploy it. But also, because I've always wanted to invest in real estate, you do have to have some cash on hand if you want to do it that way. That's probably the biggest reason, because the first reason is tricky, and you're not always going to get something like 2018, 19, where things recover so quickly, right? But because I've other interests in investing, that's why I keep a lot more cash in there.
Okay, perfect. Now, the real estate investments, do you hold properties as well, or is it more passive?
So it's limited partnerships. So it's I don't have passive. I don't have REITs because my real estate exposure is through limited partnerships.
Okay. And okay, fair enough. Now your RRSP that eventually became a pension plan. That's interesting too. But in terms of the ETFs and stocks you hold there, like what percentage is ETFs? What percent is individual stocks? Sure. Just so people can get a taste.
So if you look at my stock, the 60% of stocks, so about 70 to 80% of that is in ETFs, okay? And about 20 is in individual stocks.
I mean, that sounds really, really reasonable. So maybe we can pivot now
Sure.
and talk about when you go ahead and invest in individual stocks. So it sounds like you're about 20 to 30% individual stocks when it comes to your kind of public market investments. What's your process for analyzing a company and making a decision whether or not you think a company is a worthwhile investment?
Sure. And I think whether you're investing in a single stock or anything, you need to have a hypothesis. You need to have a reason to invest in it. You need to understand that reason. For example, when you're doing index investing, the reason I do it is really because I know that over time the stock market will keep going up. And also I know that most retail investors, which is what we are, like we don't spend hours and hours researching things, but most retail investors cannot beat the market. So that's why I put most of my money in index funds or ETFs. But other examples when you want to go into individual stocks, and these are not the most original examples in the world, but for example, I think that AI is a very important technology that's just as important as the internet was in 2000. So I think that companies who are related to AI will probably do well in the next 5 to 10 years. Or another example, another idea would be the world is moving away from fossil fuels, right? So the growth of nuclear energy will be very, very important. So I have start with those ideas, and then I look at companies which express that idea. I usually start with valuation. I'm assuming your audience is quite sophisticated, so they know about price to earnings and all the other things. But that's one way to look at valuations. It gives you an idea of how expensive the stock is. And then you compare that stock to other stocks in the same sector, because some sectors just are more expensive. Tech, what was Tesla's P at some point? Not that I've ever bought Tesla, but it was 200, even more than that. You can't really have a rule saying you cannot buy a stock that's over 20. You just look at the sector, you see how expensive the stock is, and you see if it's interesting. So once I've chosen a couple of stocks and they don't look too expensive or too risky, looking at the PE ratios, I look at their revenues. So can this company make money? It's a simple question, but you need to look at it. Can it make money? And then I look at the earnings. So can this company keep the money and invest it in growth later on? I look at the 3 to 5 years usually. I mean, they can have a one-off year, that's fine, or two off, but generally you want to see increasing earnings and increasing revenues. If they do pay a dividend, and I don't only invest in dividend stocks, I don't think that's a good idea, to be frank with you. I look at dividend growth. I do not look at yield. I think looking at yield is the wrong way to go about it, and we can talk about it more if you want. But I look at dividend growth. I ensure that it's stable or increasing. And finally, if I have extra time, I'll dig into the financial statement. But I don't always have extra time.
Yeah, you know what? That's a really, really good overview. I mean, I like hearing what you're saying because it does resemble my approach somewhat as well. So, I mean, you've been in the market longer than me. You have more experience than me. What you're saying honestly gives me a little bit more conviction. But let me ask you about a couple things there. So the
Sure.
earnings. Oh, and also just for people listening. So the price to earnings ratio, you'll take the price of the stock, you'll divide it by the earnings per share, and then that will give you the price to earnings ratio. Now the earnings, you're looking for something with consistent growth over time. So let's say if there's a little bit of a dip, does that kind of raise a bit of a red flag? And is that totally off your radar then, or you kind of go back to your investment thesis?
It doesn't, because if there's a dip, I need to figure out why. And a lot of companies dipped for a good reason a couple of years ago. But no, a dip just makes me look into why. A dip gives a signal, is a yellow flag to what happened. That's how it is. But I'm not gonna. If I like a company, I'm not gonna just say write it off because they had one dip. If it makes sense to me and if they recovered pretty well. It's trickier though if the last earnings is a dip though. It's a bit trickier there. That's for sure.
Yeah. And okay, so let's talk about the dividends there, because what you said about dividends was I love hearing that, because I'll tell you what, I talk to people and I got a message from a good friend who's really savvy. I'd say he's smarter than I am, but he sent me this message and he said, listen, okay, Bank of Nova Scotia and Bell, look how high these dividends are. I just went in. I just can't help myself. And you know what? For me, like if that will help some people sleep better at night, but for me, I will also place an emphasis on a company that has consistent and very strong dividend growth. And I would actually opt for a much lower yield, but one that is increasing over time and supported by increasing revenues and increasing earnings per share over time. So, there's an individual that I do follow, and I'm not taking any credit for this at all, but basically his name is Mike Heroux. He's a French-Canadian investor, and you may know him.
I know him very well.
But his approach is very similar to what you have outlined. You take a look at the investment thesis, and then you dig into revenues, hopefully increasing over time, earnings per share, hopefully increasing over time, and then consistent dividend growth. And there's evidence out there, and Matt Pointer also shared this on my podcast, that dividend cutters perform really poorly over time. So best to try and avoid those. Yeah. So if we go into dividends a little bit more, how relevant are dividends to you? Because there's a wide spectrum out there, and I'm not trying to stir controversy, but your point of view would be very valuable.
It's getting controversial, right? It's like polarizing. You have people who will hate you if you invest in dividends, and people who say you must. But so I like the way you phrased the question, because you asked me what my approach is. Because the way I use dividends, it's a screening tool for me, because in general, companies that pay out dividends on a consistent basis, that's the important part here, tend to be higher quality companies. They tend to do better during harder economic times. Because my whole idea is I want to protect my capital. I'm not so much interested in having a huge alpha. I don't think I can grow my portfolio better than people that are spending hours this a day. But I want to make sure that when there's a downturn, my capital is protected. So a dividend is a screener. That's all it is. To me, what's important is not the dividend itself. It's the fact that a company can pay it on a consistent basis. That's all. I would actually push back against looking at dividend yield, because there's good evidence. And we can talk about it more. I've looked at it. That investing in dividend yield outperforms investing in dividend growth by about 2% a year, because of the things you mentioned. High dividend yield. Why does a yield go up? Yeah. What has to go down? What has to go down for the yield to go up?
Well, the price.
The price, yes. Yeah, and why did the price go down? So high yield is not attractive to me. The growth is. Sorry,
I thought you just meant. Did you just say that high yield will outperform growth, or was it the other way around?
If I said that, I apologize. It's the other way around.
Okay.
If you look at it, so Morningstar did a study recently on it, and they compared the three strategies in dividend investing. So yield, growth, and a mixture of both, which is fundamental analysis.
Yeah.
And growth. So if I said yield, it outperformed yield.
No worries. Yeah,
outperformed yield by a lot.
Okay, that's interesting. So you've mentioned some metrics: revenue, earnings, dividend growth. Are there any other metrics, like for the people who are really interested in this stuff? Are there any other metrics that you will dive into to solidify your decision? I
think so. Mike Heroux has a dividend triangle. Is that what he talks about usually?
Yeah.
Yes. So the other metric I would look at, except for the dividend triangle, which you've mentioned already, is the payout ratio. And the payout ratio is, and I'm simplifying things, but it's how much of the company's income is being used to pay out the dividend. Okay. Now, generally, you want to be careful, because if it's too high, then the company might not grow, because all the money is going. Because at the end of the day, paying a dividend is not that helpful to a company's operations. It's helpful to the stock price. It's helpful to getting a loan, maybe, because the stock price is higher, but the operation part is not. So what you want to make sure is you look at the payout ratio compared to other companies in the same sector, and you want a stable payout ratio. You don't want an increasing one. If it's increasing, you need to be worried that it's not sustainable. The growth is not sustainable. I would add the payout ratio there. I would start with those things if people really want to dip their toes in dividend investing. I mean, there's hundreds of other things you can look at, but those are the easiest to approach. People can also, the other thing about dividend companies is you can actually, if you're really into math, you can estimate the valuation. Have you done any dividend discount model work?
No. I have. I tried to watch a video on it recently, but it's one of those things like. I was out for a jog and I was like, oh my God, I need to sit down, pen and paper, and actually this is not the type of stuff you should be doing when you're exercising.
It's not too crazy. It's fun. It's not the most accurate thing in the world, but you can do it. You can do it, and if you want, you can get an idea if you're overpaying for a stock another way. It's much harder to do without dividends.
One thing I've started to do is I've also started to look at a company that fulfills all these criteria that you've talked about so far, its price to earnings ratio, how does it kind of compare to its historical average as well?
That's a good point.
It's just, I think maybe me and the way I was raised, I don't really like to overpay for things, and also acknowledging that more time in the market is a good thing overall for the long term. But yeah, I don't like to overpay for things, so I will tend to add or buy when I feel like, hey, maybe this valuation is favorable compared to historical norms. Does that factor into your approach at all?
That's a really good point. I didn't mention it, but certainly I sometimes do it, but not consistently. I should probably do that consistently because that's a really good point. Yeah, the P ratio. Because are you getting a deal, right? The P ratio is on all-time low. You make sure everything else is fine. You're buying it at a better price than if you.
But then the counterpoint to that is you don't want to fall into a value trap, right?
True.
Like the PE ratio could be plummeting for a reason that will not benefit us. So.
Yeah. That's the thing about individual investing. You can't just look at the ratios. You have to actually dig deeper a bit, right? You have to dig into what's happening, and you can't just use one thing to make an investment. You can't just see the PS to be this to invest.
So, Dimitri, with inflation, it's coming down, but it's still higher than where people want it to be. And I guess if we stay in a higher than average inflation environment, does that change the way you approach things, or does that change your investment thesis and sectors you may favor or things you may do at all? I'm just curious.
So the inflation is an issue because I think it's pushing people to take more risks, to get bigger returns, to get the actual the net returns. Mm-hmm. But the only thing it's done for me is I invested in real estate. That's it, because real estate might do better during inflation. I mean, I already have exposure to oil companies because of my other thesis. Mm-hmm. So they might do better. Though with oil, I think, unfortunately, it's more of an issue with what's happening in the world than inflation. I mean, it comes together, but I think it's because of the instability. Mm-hmm. I have my crypto and precious metals, but I haven't increased my my exposure. And precious metals haven't been doing as well as they should have. And, I guess I've invested in some grocery stocks, but that was not the best idea. I don't know yet. And what have you done? Have you have any ideas? Because mine aren't very original.
No. Honestly, I'm probably going to talk about the details of my approach in a separate episode, but I'm going to address some of it now. So
Gotcha.
what I try and do is, for the US and the rest of the world, I try to stick to an ETF. Now, truth is, I've had very few huge winners, and I think this goes well with the book, The Psychology of Money. They have a chapter there. Morgan Housel has a chapter there called Tails You Win. And there's going to be a few outliers that will probably, in your portfolio of individual stocks, drive the majority of returns, the lion's share of returns. That's been my experience too. And I almost nearly exited one of those positions earlier this year. And so now I'm sticking to mainly ETFs for US and the rest of the world. The one I like to use is XAW, XAW. So it's got a pretty cheap MER of 0.22%. And it gives me exposure to the United States, to the Europe, and a little bit across the world. So I kind of like that. Now, for Canadian exposure, I could take another ETF like VCN, which actually has a very healthy dividend yield as well of around, I think, 3% or so. Mm-hmm. But what I try and do for the Canadian stocks is, because I'm a little bit more interested and I like spending the time, even though some may argue it may be a bit of a waste of time, but for me it gives me a lot of joy to keep up with things and learn about the world. So I try to invest into individual Canadian stocks, and so then I try to cover the sectors. And so in terms of grocers, you mentioned, so I do hold one. One is Empire, and that's one that I started a little bit earlier in 2023. But again, it's a company that I follow, and it's a company that I've dug into their earnings, and I'll tune into their calls if time allows. I don't know if it's going to be one of my top 10 core holdings, but that's kind of my overall approach. But things that have kind of caught my eye recently, like when the utilities dipped, like Fortis for me is like a core holding.
Yeah.
Some people laugh at me for holding a utility, but I think it's a very, for me it's a very sound company. It checks off all the corners of the dividend triangle. Another one, I find some of the industrial stocks to be quite interesting too. So I've been a holder of Waste Connections for quite a while, for about 3 to 4 years, and that's one that is a core holding for me as well. And those are two of my more kind of recent buys and things I continue to eye. So that's my approach in a nutshell, if that makes any sense.
It's a good approach, and it's similar to mine because, and I think you mentioned time, right? And I think you mentioned so that's the big question, right? How much time do you spend if you do individual stock investing? And
that's my next question, actually, Dimitri. And you know what? I just want to make it really clear to people. Like, I've thrown out names of companies, you've thrown out some names, and I always tell people, when you're listening to me, don't listen to a random kind of podcast with a shaved head. You got to do your own due diligence. And like, my approach may not work for you. Dimitri's approach may not work for you.
100%. And
you know what? It's very possible that down the road, I may learn some painful lessons that may force me to tweak, but you live and you learn. And I will mention one thing. With the kids' money, the RESP, that's index funds.
Yep.
I try not to pick too much there. I just kind of drop it into a worldwide index fund. But okay, time. How much time do you spend on this, Dimitre? And like, who should do this and who shouldn't do this?
So that's the question. I mean, and you said it yourself. I enjoy this, right? So the time I'm spending doing this it's time I like to spend doing this. But you can easily spend 2 hours a week or more. You can easily spend 2 hours a week or more on this. I would say because if you go in with individual stock picking, you want to have at least 10 stocks, 5 to 10 stocks. I mean, 10 would be a good target here.
Yeah.
So 1 to 2 hours. And quite frankly, if you hate doing this, if you hate looking at stocks and logging into your online brokerage, there's no reason to do this. You and I are doing it, I think, because we like it. And because it gives me joy. I like numbers. I like charts. I like opening my own brokerage. I like all that stuff. So those 2 hours are, to me, as a hobby. It's a rest. Quite frankly, if you don't like it, I mean, ETFs, they even have asset allocation ETFs now. You don't even have to rebalance anymore. Right?
Yeah, that's a very good point. You take something like XEQT, XGRO, and your asset allocation is there, and then they will rebalance as well. So, no, very, very fair point. You mentioned your interest in psychology, and I want to kind of go back to, over time, you have 15 years of experience investing by yourself, and you mentioned at the start of the podcast that a lot of investing is about behavior. So I guess, what are your personal tendencies and pitfalls, and then what are some checks that you kind of impose on yourself to make sure that you don't act irrationally, or you minimize the likelihood of that happening? Because I do agree with you. I think a lot of this is mental, and I can address mine after, but I'd like to hear yours first.
So I think one of the tricky parts about investing in individual stocks, and it happens with any investment, but it's you tend to get emotionally attached to the company sometimes, and you don't. I have had tendency not to stick to my exit strategy and follow the company all the way down, because I'm like, this company should succeed. Then I start ignoring the numbers. I start ignoring the dividend triangle, and I start magically thinking that just because I want it to succeed, it will. The stock market is a very humbling place. That's why I like it, because it keeps my arrogance in check. Because we're doctors, right? We know everything. But no, I have an issue with sticking to my exit strategy. So that's why I try to really write down my hypothesis and my exit strategy before I buy an investment, and I look at it. And I still make mistakes. And I still sometimes think that I'm smarter than the stock market. You never are. But writing that down has helped me a lot, and actually looking at it on a regular basis.
That is fascinating. Okay, give me 1 sec. I just want to just check up on my son, just 20 seconds, and I want to follow up on this point. Okay, Dimitre, I'm fascinated by that last point, because you said you write things down. And one practice that I also took on in 2023 was, before I make an investment, if it's in an individual company, with the ETFs, I just try to put it in regularly without fussing too much about what the market's doing.
Right.
But with the individual companies, I will basically write down my investment thesis for that company. I'll basically write down what the trend is for revenues, earnings, and dividend growth, as you talked about. and then I'll summarize by kind of saying, okay, at this point in time, I think this is a position that it may be worthwhile to add to it, or you know what, I'm going to hold on and I'm going to wait till earnings. And I can tell you with one company where I decided to wait a little bit was one in my portfolio that has not done well. So one is Jameson Wellness. They basically are in the vitamin space and consulting space, and they're growing a bit, but when I looked at their trajectory on their last earnings, it wasn't as much as I had hoped for. And of course, they have expenses that are weighing down on them as other companies do. But I decided to kind of wait a little bit. But what I like about writing things down is it tells me, like, what was I thinking about this investment at that point in time, and how have things changed since then? So has my hypothesis on this company changed? Has my thesis changed? And it just gives me a summary over time about what I've been thinking, and that's helped me a lot too. So it's amazing that you
practice.
do.
Yeah, it's a good practice.
It's amazing that you do something similar.
But it's good practice for life too. Just keep yourself accountable to your investments, but also write about.
Yeah.
Have a journal. Most successful people have a journal. But no, I agree. I started writing things down because then I'm looking and I'm like, this is what I wrote down. This is because when you're in your head, you can start telling yourself little lies like, oh, this is not why I bought the company. I think this is why I bought the company. So it's great. That's what I do now. For sure, 100%.
Yeah, and your point of being emotionally attached to a company because it's already in your portfolio, that can be very intense sometimes. I know it's happened to me for some of my holdings, but when I'm writing things down and critiquing the companies, it forces me to basically move away from that emotional attachment a little bit. So I like what you mentioned there. Now for me, I think the fear of missing out has been powerful at times. Like sometimes I'll say, oh, you know what? I'm going to hold off. I'm going to wait for a further dip in price, and then the price goes up. And then that for me, that can be a very powerful emotion. And I find if I'm checking things too frequently or thinking too short term, then I can act irrationally. So I also try not to be on Yahoo Finance all the time. I actually let go of the app for like 6 months. But then I found that there's a small part of me that was a little bit upset that I let it go. So I introduced it back into my life, but now it's much more intermittent when I check it. I'm definitely not on it all the time. And in fact, the days when I'm on it a little bit less are probably just more enjoyable days. But that's another thing that I've had to battle with, the fear of missing out. When things are going up, everyone around me is doing well, the market's doing well. And if I haven't participated, that's tough for me. Hence, I think I've probably lessened the amount of cash in my portfolio and opted for a balanced approach, but making sure I'm in the market for longer. But I'll sum it up with that.
Yeah, and I went through the FOMO phase. We all go through that. But you eventually figure out that you're only racing with yourself, not with other people or the market, right?
Exactly.
And yeah, I know I'm going to get criticized for the cash position. Everybody don't have a 20% cash position. It's just me.
It's all good, man.
It's all good.
You mentioned some of these one-stop shop ETFs will automatically rebalance, which I think is a great thing. Do you rebalance your own portfolio? Like quarterly, twice a year, annually? What do you do?
So there's two ways to do it. So you can rebalance, there's two methods. You can do it calendar-based, so as you said, quarterly. And you can also do it threshold-based, which you say if it's beyond 10% of the initial threshold, I rebalance. I mix both. I do both. I check it every 3 to 6 months. And if it's within the threshold of about 15%, I don't touch it. And that's what I've been doing. Rebalancing is great. Everybody should do it. It's consistently been shown to improve your returns by 1.5 to 2.5% a year. So it's worth the time to do it. It's easier to do nowadays. First of all, you can just get an asset allocation ETF if that's what you want to do. Secondly, there's an app called Passive. I think it's called Passive that I use. It's a bit easy. It tells you how to rebalance. Back in the day, I had to use Excel, and I don't mind it. I like math, but it's much easier with this app. Probably not the only one out there, but yeah, rebalance. You need to do it 100%. It's for many reasons.
You mentioned the stock market can be a very humbling place. I'm curious, over your 15 years of investing, Dimitri, what are some of the key lessons that you've learned?
Sure. You need to have a very good understanding what you're buying, okay? You need to be humble. You have to understand, whatever investment it is, whether it's real estate or anything else, how does this investment work? How is it going to generate a profit for you, but also how does it generate a profit for the people selling it to you? And if you don't understand that, if you can't explain the investment to your partner and during the dinner, then you don't know what the hell's happening, and you shouldn't invest in it. You need to be humble, you need to understand it, and you need to ask questions. And I ask questions, and I need to know what I'm getting into. The second thing I mentioned is you have to have an exit strategy before you buy any investment. You just have to, and we talked about why. For example, if you're index investing, your exit strategy would be, well, when I retire, I'm going to sell a certain percentage of this every year to live, right? Or if you want to go technical analysis, I'm not saying people should do that, by the way. I'm just giving you examples. But whenever this stock reaches the moving average, 1 year moving average, I'll sell it. Or what we do, which is look at earnings and revenues. You have to have an exit strategy before you buy the investment, whether it's real estate, whether it's a house. You have to have some kind of exit strategy. I find that it really helps you. And the last thing that helped me with the FOMO is, to me, the goal in investing is, for my retirement, is not to beat or match the index for my friend, who's much smarter than me, by the way. It's to protect my capital on the way down. Because the way down, and maybe because of 2008, because I saw what happened, the way down can change your life the worst way. The stock market doesn't owe you like a bull market during your retirement years. It doesn't. So you just need to know it's more important for me to protect my capital than to have extra returns. And that's what helped me with FOMO, to be frank with you, a lot.
Yeah, I think that's really well said. As we are about around the same age, moving from early career to mid-career to career shifts, and so now as you're progressing in your life, investing is one piece of the puzzle. But Dimitre, I'm wondering, like, what else are you thinking of as a part of your overall financial plan, your overall financial journey, in addition to investing?
Death and taxes, yeah. So is death and taxes. Taxes, I'm sort of understanding finally, right? I'm sort of getting it. Even though now having a pension plan, I have to relearn a couple of things. But the big thing that I'm trying to understand, again, is estate law and estate planning. And you know what's funny? Yeah, and I've gone through lawyers multiple times, and they always explain it to me. And last time, this lawyer actually took the time to write it down on a board and do a presentation. Like, I get it. It makes sense. I left the room and I'm like, it doesn't make any sense. It's like a different language. Actually, I noticed you had a podcast with somebody, Amanda Doucette, right?
Yeah.
Who talked about it. I'm going to listen to that. Hopefully that helps me. But
she's good at explaining these concepts.
Nice. Yeah. But because we're getting older, our parents are getting older, it's all about these. I'm really going to the estate planning, trying to understand and trying to make sure I know what's going to happen. When unfortunately I die, and unfortunately my parents, everybody dies, right? So that's what I'm focusing on. And I'm going to listen to that podcast right after, I promise.
No, you know what? And I'm going to follow up with you. So let me know what you thought of that one.
Sure.
Because, I do agree, Dimitre, like, these are things that just tend to get less attention. We tend to be, and I think partly it's because we start earning a little bit later. Many of us have a lot of debt. There's a lot of emphasis on the accumulation phase, and then less emphasis on other things. So decumulation, how do you do that in an efficient and evidence-based manner? And then also in terms of passing things on in a tax-efficient manner, how do you do that? So these are things that I'm learning about as well. And we're going to have a few episodes coming up that hopefully might address some of this. Now,
I hope so. Teach me. Teach me. It makes no sense.
You now have a pension plan, you mentioned. And maybe for another conversation, but I would love to. I know we've talked about it before, but I'd love to learn a little bit more about that. But it sounds like that's a decision that you obviously took some time to make, and you seem to be overall pretty content with that. Hey?
Yeah, it's not for everyone, but it made sense for me, and people should look into it. I think you had Mike Soth on, right? Mark. He is. Sorry, Mark. He has a great article on pension plans on his blog, actually. That was very helpful. I suggest people look into.
Yeah, absolutely. Yeah. So I think we all get to where we are with some guidance along the way, whether it's mentors. You said you started reading books and listening to podcasts early. I have to commend you, Dimitre, because I was in medical school when the the great financial crisis. The global financial crisis was in full force, and I was like, I knew it was happening. I knew things were not good, but I didn't put it on myself to learn and basically immerse myself in that and take advantage and start early. You did. So I have a lot of respect for that. That you must have been mature beyond your years to do that. But what I mean, what resources would you recommend to people who are looking to either introduce themselves or just dive deeper and learn about these concepts?
So I'll start with the podcast because that's giving our lifestyle how busy it is. You can listen to them while you're doing the dishes or whatever, doing chores because we don't have time. But if you want the big picture macroeconomics, and if you like that type of stuff, you don't actually need that type of stuff to be a successful investor. But if you like it, and if you want to have some ideas about hypotheses you want to have, Real Vision is the place. It's really? Not more than a podcast. It's. I mean, I'm a member. I have a paid membership. You don't have to do that. You can just go to the YouTube page. But they just have amazing, high quality guests. They have an academy which teaches you like investing, like the basics of investing, and they're very knowledgeable, very humble. I tend to listen to their daily wrap every day after I come home from work, and I love it. But it's if you want the big picture. Yeah. You don't need the big picture.
Maybe I'll give that another go because I briefly had a paid membership. I was listening to their podcast in the morning as well, but I guess I found that I just didn't have time to dedicate to it, but I might give it another go. That's interesting. Thanks for sharing.
Yeah, so I do, and I love them, and I listen to it all the time, but your mileage might vary for sure. The one I would suggest to everybody, actually, who's invested, it's called the Rational Reminder Podcast.
Yep.
It's Ben Felix and Cameron Passnor. So Ben Felix has a YouTube channel as well. He's very much against dividends, by the way. So he's a hater. I'm kidding. But that podcast, that podcast is so good. Talk about evidence-based, because it's so hard to get evidence-based stuff in finance, especially for retail investors. We don't get access to the research. You have to pay thousands of dollars. They are evidence-based. They explain things so well. And I think anybody who wants to be more involved in their investments should at least give them a listen. I love them. They're amazing, I find.
No, that's an amazing resource, absolutely. I'm glad you shared it here.
In terms of books, so it's funny, Psychology of Money is one of them.
Yeah.
Yeah, so it's a great book on decision making.
It's so phenomenal.
Good.
Phenomenal.
The other one about behavior is Thinking Fast and Slow by Daniel Kahneman.
You're the second person today to mention that. My last guest mentioned it too.
You should check it out. System 1, System 2 Thinking. It's one of those books that like opens your eyes about how things work. It's life changing, I think. If you want bigger like sort of the macroeconomics, I would really suggest people read Pragmatic Capitalism by Cullen Roche. Mm-hmm. So that's the type of book though you need to be engaged. You have to sit down and you have to write. Okay, it's like, but he makes sense of the system and how it works, and it clicks. But it takes time. It's not an easy book to read.
Okay,
it's easier than most books I've read about this, but it clicks. It's very well written.
Okay,
and you're gonna laugh at me, but I'm gonna be honest with you. Okay, because I'm looking at my bookshelf, and one of the books that has the most bookmarks and like highlighters, it's Fundamental Analysis for Dummies.
Oh, really?
By Matthew Krantz, which is one of my first books I read when I started teaching this stuff.
Yeah.
And it's not the best book in fundamental analysis. It is not at all. But it has so much stuff in it that it's really easy to go back into. And I think it's a very approachable book to start with. I'm going to get laughed at. The guy with the 20% cash position and fundamental analysis for dummies, but I'm just being honest.
I think you may become known as the guy with the 20% cash.
Yes, great.
No, but honestly, I think it's a good thing. Cash is not trash.
Cash is not always trash.
I'm writing down all these names, by the way, so I'm gonna.
And it's becoming a Kevin Myler love fest, but I was really lucky to have him as a mentor.
Yeah.
He really pushed me out of my comfort zone. I grew up poor, so I had a really bad relationship with money. I was damaged, and he pushed me, and he made me realize that some perceptions were wrong, and he really allowed me, really like supported me, and believed in me, and gave me the confidence to start investing, because it's scary. It's scary. Like when you see the losses sometimes, it's scary. But when you have somebody who just gives you confidence. I mean, I wish everybody in this world can have somebody like Kevin in their life. I wish, because he's an amazing mentor.
I can tell you that every time I have talked to him, I've left that conversation unequivocally feeling better about myself every single time, and he just has that ability. So, yeah, thanks, Kevin. I mean, I hope you're listening to this.
Yes, thank you, Kevin.
Yeah.
But yeah, that's what I would say. Start there. The podcasts are a great resource. Amazing resource. Yeah.
Okay, man. I love that. Okay. Should we do a quick rapid fire?
Sure. Let's do it.
What's your best investment?
It's an ETF. It's not a dividend stock. It's a US. It's a US total market ETF by Vanguard. VONTO. Consistently since I bought it, has been doing great. Obviously, there was some down years, but it's just one of my go-tos. When I'm feeling bad.
What is the ticker?
It's VONTO. It's the Canadian version of and when I'm feeling stupid, I go back to it. I'm like, okay, at least I bought some of that, and it's doing okay. That's my best investment.
Amazing. Your worst investment?
So 2008, I thought I knew what I was doing. I spent all the money I made from working in the lab at U of T on silver. I walked into the Scotiabank vault, which back then you could walk into and just put my wealth of cash in silver. I was convinced the system was going to collapse. I was convinced I was going to be able to buy a yacht with the silver. I bought it for about 41 an ounce. It's what, 30 now? I'm looking at it. Yeah. So I'm 50% down without inflation, and it's been 15 years. So yeah, it's bad.
Wow. What's the last stock you bought?
Alimentation Couche-Tard.
Oh, wow. Perfect pronunciation
yes.
as well. Yeah.
I was practicing pronunciation in my head.
So, well done. So that's a core holding for me too. It's just one of those no-brainers. For me, again, guys, don't listen to me.
Don't listen to me either.
What are you eyeing in terms of upcoming investments? Anything catching your eye?
Sure.
Maybe one day enter your portfolio?
Uranium.
Yeah.
I don't know. Maybe it's the wrong hypothesis, but I think if this transition is going to happen, they have to go nuclear at some point. So things like TC Energy Corp or Cameco, which is a Canadian stocks, or Constellation Energy, which is a US stock. I'm looking at those. I haven't pulled the trigger yet. Especially some, and then again, I'm not saying people here should invest in those, but do due diligence. But that's what I'm looking at.
Okay. Any advice or final words as we wrap up?
Sure. What I would say, so I'm very lucky that I've had three people in my life, three of my best friends who are all very much into entrepreneurship and like doing their own thing. I think what I realized by looking at them is when you're trying to build wealth, don't focus on money, okay? Focus on a problem that needs to be solved, and wealth will come. And that's how I try to live my life now. There's always ways to make more money as a doctor, but try to solve a problem. And that's what's brought me to my career and to a changing career now and to being more happy, trying to solve a problem that's there. But I'm paraphrasing my three friends. They're wiser than me, and that's what they've told me in many different ways. And that's what I'm trying to do myself.
I love that. Short and sweet, but I think that's really powerful, Dimitre.
Thank you.
So, listen, we finally got to sit down and record an episode. I love this. I wish we could keep talking. And I think this is kind of now the sweet spot for my episodes. But, Dimitre, I want to thank you for making the time.
Of course.
I love your curiosity and your desire to always learn. So keep that up. And, with the near future, the long term, wish you all the success.
Thank you. It's been a pleasure. Thank you for your time as well.
Absolutely. Take care.